Better now?
Yes, better.
Okay. So
We have around 10 people now.
okay, 10 people. So guys, good evening, and so I'll give a brief background about myself, what I do, and then I'll dwell into various alternative investment opportunities, and discuss how we can invest in various asset classes. And second thing is, I want this session to be interactive because it becomes more interesting, and there are a lot of queries which will come out based on our discussions, and it will be helpful for the whole group. So guys, I work in the in derivative structuring and trading. So, and I'm quite interested in alternate investment asset class, and I work both professionally and personally. I spend a lot of time investing in alternate asset classes. So, and something which I really find quite fascinating. So I write a blog also on alternative investment called Random Dimes, and so I do both. I mean, I invest my own money, and then I track portfolios, I track performance of all those assets and write about it. So guys, you can just have a look if you are interested in alternative investment. So before going into alternative investment, I would like so I would like to ask you, so what all investments do you know about? So I guess most of the people they will have hello, yeah, yeah. So I'm saying a lot of people would have experience in investing in conventional asset classes. So before I go into alternate investment asset classes, I would like to know what are the conventional asset classes you have invested in the past or about. So that will give me a good understanding of the knowledge. So I guess so a lot of people would be investing in mutual funds, and then there will be a lot of people who would be investing in provident fund because provident fund, because a lot of it is tax exempted, and automatically it gets it gets deducted from your salary. Then real estate, I mean, this is one of the oldest asset classes. I mean, our parents used to tell about real estate, and then we got to know it, and for them it has been one of the most lucrative asset classes, right? And then gold is something which Indians they invest a lot. I mean, they do it in the form of a jewelry. Now a lot of gold bonds and gold ETFs have come up in the market, and people are investing in it. So if you think about any asset class, so it can be primarily divided into two categories. I mean, it can be divided into as a debt or an equity, right? Be it your mutual fund or your provident fund. So why do some people take debt and why do some people take equity? I mean, so when you invest somewhere, right? Somebody is giving you a return, right? Why does someone give you that return, right? What is the reason for that? So the difference between debt and equity is, for instance, let's say I'm a company or I'm an individual, so I have requirement for money, right? So when I take debt, let's say I take 100 rupees from you, the obligation is to pay back an interest, 10 rupees it's interest. And if I take money in the form of equity, I have to give up a stake in my company. So if you buy 2% of equity, so you are buying a 2% stake in my company, and the price I'm paying you for that equity is the valuation of my company, right? So in terms of debt is expensive, right? Because if as a company, I take 100 rupees from you every year, I have to pay you 10 rupees, and there'll be a lot of times when I would not be able to make those 10 rupees or generate those 10 rupees in cash flow, and then I'll be in a difficult situation. That is what happens with a lot of companies where you see they say that the company is defaulted. It means that company took some money from people, but it didn't have that much of cash flow or money to pay back that kind of interest, right? The other way, what the company does is they take you buy the equity of the company. In terms of equity, company doesn't have to give you anything, right? So company, they can give you dividend, but otherwise, if I buy a stake in, let's say 10% stake in a company doesn't have to give me anything. But tomorrow I can sell that stake to someone else at a higher price, provided the company does well. For instance, let's say 20 years back, people bought HDFC, right? So HDFC was a small company then, so they needed money. So they said, okay, we'll sell our equity. So the equity, the waste through an IPO, right, or through the stock exchanges. So a lot of people, they bought the equity. Let's say HDFC initially it had 100% stake. Now they sold 20% stake at some valuation, and people bought those shares. Now HDFC become a big company now after 20 years. So that those shares which people were holding, they became quite expensive in valuation, and they were able to make money. So that way, people, they had some kind of belief in HDFC, and for them it worked, right? The opposite can also happen. A lot of companies, they don't do well, so they collapse, and then you do not get anything. So like the risk an equity investor takes is much more than a debt investor, right? That's why the upside is also much higher for an equity investor. So now we come to alternative investments. So what do you understand if I say, or when I say you invest in alternative investment? What is your basic understanding of alternative investment? So any answers? What do you consider as an alternative investment?
Is it real estate?
Real estate, I would not consider as an alternate investment, because real estate, people have been investing in real estate for a very long time now. People were buying houses, those that was real estate. People were buying lands, that was real estate, right? So real estate can be considered as an alternate investment if the mode of buying real estate becomes different from a conventional method. Right now, you just go, do a transaction with someone. But if tomorrow, there's a new way to purchase, real estate, yeah, through some different platform, right?
Right.
Like these days you have fractional real estate, then it will be called an alternate asset. So alternate asset by definition is any asset which is not your conventional investment. So
Okay.
probably like mutual fund, equity, and bonds, these are your conventional investment. People have been doing that traditionally. Alternate asset is something which is different from these. Different in what way? Different. It could be, different in the correlation to these assets. For instance, when I say correlation, I mean, for instance, equity, if Infosys goes up by 10 rupees, Nifty goes up, Nifty also goes up by, some point. So there's a higher relationship between these kind of assets, which are similar in nature. But an alternate assets, could be something which does not move with your, normal stocks. So that in totality, your portfolio is less volatile. Let's say, for instance, I'll give you an example. If you buy 100 shares of equity Infosys, and you buy 100 rupees of Nifty. If Nifty goes up, your Infosys goes up. If Nifty goes down, Infosys goes down. So there's a high relationship between these two, assets. So your portfolio moves in one direction, right? Which is not good for you, because it means if the market, goes down by 30%, your Infosys share will also go by 30%, and your portfolio will also go down by 30% or 20%, whatever. But if you have something which is not related to these, kind of investment, then let's say that asset does not go by 20%, it stays at the same level. So your overall portfolio returns becomes better, and you do not lose that much in a market crash. So that is one reason why people invest in asset classes. So some of the examples for an alternate asset would be one. So like they said real estate. So the example would be a fractional real estate, where instead of buying, a land directly, you can buy a small percentage of land. you can buy 1% of a house. So I'll tell you what is the benefit of buying a fractional real estate. So a lot of people they tell me that their parents, they invested in a house, and which became 10x, 5x in 20 years, and land or house is the best investment you can possibly have. So a lot of people do not realize the reason they made that much money was not just because of the house price or the land price. It was because of leverage. So what normally your parents or we used to do after 20 years back, we used to take a loan, let's say, and used to buy a house. So let's say you take 80 rupees loan and you put 20 rupees of your own and you buy a house for 100 rupees, right? The cost of that 80 rupees loan, let's say the interest rate was 10 rupees and 10%. So you have to pay 8 every year for that loan. And let's say the house only appreciates by 12% a year or 10% a year, right? So now what will happen in the first year? You make 10 rupees out of your house. 8 rupees you had borrowed that you paid for your interest. 2 rupees is left. So how much you had made? You had put in 20 rupees and you got 2 rupees, at 10%. Instead of 10%, if the house goes up by 12% a year. So how much you make? 4 rupees. And how much you had invested? 20 rupees, right? So you end up making 20% in a year. So that's why because of this leverage, your returns magnifies. So this is but it looks too good to be true. But see, it's a two-way sword. What if the prices of the house had collapsed? So we were in a zone where the house prices constantly increased over the years, especially after 2009, 2014, 13. But if I take example of places like Noida, for instance, the house prices remain stagnant. So the same example, you took 80 rupees loan and 20 rupees is your own. House price does not move for the first year, right? So you have invested 20 rupees and you have to pay 8 rupees interest. What is the loss? You're losing 40% in a year. But a lot of people do not realize that, because what they do is they say, okay, rent, house rent is this much, my EMI is this, house rent is equal to EMI, that's why I'm not making any loss. But if you do a calculation on Excel spreadsheet, you'll realize that that is not a very transparent way to compare your returns. So you have to see what is the interest cost, what is the expected return from your asset. So the problem with buying a big house is that you are investing, or you are concentrating all your investment in one particular direction. So let's say your earning is 10 lakhs and you're buying a 1 CR house with, let's say, a 70 lakhs loan and 30 lakhs is your own saving. So now what happens is your net worth is 10 to 30 lakhs, but your investment is 3x of your 3x of your net worth, right? Second thing is, even if you invested anywhere else, let's say stocks, you have a 2 lakh portfolio, PF, you have 5 lakhs, whatever. Still your house 1 CR is much more than your, all your assets combined. What happens is you are so highly concentrated in one particular asset that if, for instance, the house price collapses, or second, if the interest cost goes up. Right now we are in a low interest rate environment, let's say, but you have a 30-year loan. Let's say after 3 years the interest rate goes up by 5-6%, right? Or let's say what happens if someone lose a job, right? Then the thing is, you end up in a really bad situation. So it is not advisable that you invest a huge amount in one particular asset. So you can first assess what your net worth is, how much you can invest. And second thing is, you should not mix investment with possession of an asset. A lot of people, they buy house as a possession and they claim it to be an investment, which is not right, because buying a house for living is different from buying a property to invest. buying a house is like almost like buying a car. You do it because you want to own that. You want to have that sense of ownership, right? So you should not confuse it with being, an investment, right? That's why fractional real estate investment uh, has come into play. So if you go to, if you check out, some of the platforms in Europe, so fractional real estate is very popular. What is fractional real estate? What they do is, so let's say there's a property which is worth $100. What they do is they buy that property and then they issue kind of shares on that property or tokens. There are different ways of doing the same thing for 100 rupees each. So now what happens is 100 different people can buy 1 rupee property, right? So that way you have 1 rupee property, you have 1 rupee investment in that 100 rupees building, right? You can then buy 1 rupee investment in 10 more buildings. So that way you have diversified your risk of owning one property, and now you don't have to take that kind of loan to do that, right? And then thing is, and a lot of these properties are commercial grade properties, and commercial grade have higher rental yield than retail property. So it gives you a better diversification and better returns, right? That is the fundamentals of fractional real estate. Fractional real estate is just one of those assets. So let me talk about the other assets. So a lot of you might have heard of invoice discounting. So invoice discounting is, basically it's a very old, it's a very old method, or it's a very old investment done by a lot of companies, a lot of NBFCs, non-banking companies, financial companies like Bajaj Finance and Tata Capital, and a lot of corporates. But a lot of retail investors, they were not able to do it because this was not accessible a few years ago, because there was no technology to bring it to the retail audience. But now a few platforms are offering investment invoice discounting. So what is invoice discounting? So let's say there are two companies, company A and B. So company B is a big company, like in the league of, let's say, Amazon or Flipkart, and company A is a vendor which provides some service to Amazon. It could be a seller on Amazon, or it could be providing some services, technology services to Amazon, or logistic services to Amazon, right? So what happens is they do some business for Amazon, and Amazon owes them money. So when someone owes you money, what do? Is you raise an invoice, right? So that company, say that company A did a service for Amazon, they charged 100 rupees for that, and then raised an invoice for 100 rupees. Now what happens is, Amazon being a big company, they will take time to process the invoice. So let's say the time to process that invoice is 45 to 60 days. Now company A is quite small in nature. They need capital for them. They need to, provide salaries, or they need the working capital for their operations. Now they can't wait for 50 days for Amazon to process the invoice. So what they say is, instead of 100 rupees, if somebody gives me 90 rupees today, Amazon can directly pay them, right? So, and that 90 rupees after, let's say, 100 days becomes, is you pay 90 rupees to that company, and 45 days you get 100 rupees. So in a way, they have discounted their invoice. So which means the investor get the 10 rupees, extra 10 rupees for that 45-day period, right? And now for the investor, the risk is, if Amazon does not pay that invoice, that can happen in two ways. One, that invoice is fake. Second, Amazon does not have the money, right? So chances of Amazon not having money is low. It's not impossible. You cannot say it's impossible, right? These days, everything is possible. But second part is, invoice can be fake. So for that, there are a lot of platforms which do the due diligence of that invoice and of the vendors. So if you can see my blog, there are a couple of platforms which provide these services. So, and the expected return on these kind of assets is around 12 to 13% annually, which is much higher compared to, let's say, your saving account rate or your fixed deposit currently, which is yielding around 5%. And thing is, the liquidity is quite high. In 45 days, you're able to get back your principal. So this is an interesting opportunity. Of course, what you should realize that you should first read the finer details, like what kind of vendor is there, has the vendor done business with the on this platform earlier, and which is the counterparty, it's a big company like Amazon or not. And these things you have to factor in. You can start small and then do your own research and then understand the risk and then invest. This is one platform. Another interesting investment will be, there's a new investment called equipment leasing finance. So what is equipment leasing finance? Again, this is an old business idea which has been traditionally done by a lot of big companies. Now it is available for retail investors also. So investment equipment leasing finance is basically, for instance, let's say a company like TCS or Wipro, they need a lot of assets. They need laptops. They need those desks, and they need a lot of other hardware and software. They need ACs. So one thing is those company can buy those products. Let's say a company can buy assets and then use it, but that is unproductive from a company's perspective. Why? First, a lot of your capital gets stuck. You would understand a company wants to sit on cash. They don't want the cash getting stuck anywhere, because that cash can be deployed for better use. Secondly, assets, they depreciate over a period of time. So the company doesn't want depreciating asset on their book, right? Third, if that company, instead of buying those assets, they take those assets on lease, they can show that lease as a loss on the books or a cost on their books, for which they can take tax benefit, right? So this gives an opportunity for investors. How? So there's some interesting platforms in the market. What they do is they pool money from investors in an escrow account, which is in a special purpose account where they cannot touch the money directly, and these accounts buy those assets. So let's say 100 people, they pool money. Let's say each one of them, let's say, pool 20,000, and that combined money is used to buy laptops, right? The laptop is in the name of those investors. Now those laptops are leased to those companies, right? And that company, let's say 100 rupees laptop is leased to that company. The company puts in some security deposits, say 20 rupees, and every month that company pays that lease for the laptop, right? So the benefit is, for the investor, these assets generally, the lease is high. It's really 12 to 13%. Second thing is, this you don't have to pay tax on this, because this money is coming in an LLP, right? And that LLP, your assets is also depreciating, right, every month. So that lease money gets offset against the depreciation of the asset, right? And after, let's say, 3 years, that asset, 100 rupees asset, is worth 30 rupees. Then that company, the company to which you have leased those assets, buy those assets from you at 30 rupees. So, right? Or if that company doesn't want to buy, then you can sell those, the platform sells it to someone else. So this is another, alternate investment, platform, which is provide equipment leasing finance. And you can expect around 12 to 13% annualized return on this. And the good thing is that your investment is backed by the assets, like, which in this case will be laptops or ACs or bikes. So in case of a default, you can always sell those assets and recover your principal. So this is another avenue where people can invest. Then there are peer-to-peer lending platforms. I think this is not a new concept anymore in India, because in the last 2-3 years, a lot of platforms have come up. So and what happens in peer-to-peer lending is, let's say there are borrowers who need money. But for instance, if a borrower needs 1 lakh rupees, a lot of banks, big banks, they're not interested in giving that money because it's too much of an effort for them, and the customer is too small, or he's not working in some blue chip company. So they do not want to invest their time or bandwidth with in that customer. What happens then is, this platforms provide an opportunity for those kind of borrowers and investors. So these platforms, what they do is they lift the loan requirements of those borrowers. So let's say I want some money, so I go to this platform and say, I need 1 lakh rupees. So the platform does what the platform does. It takes all my salaries into account, all my previous loan, my CIBIL rating, and everything, and then it posts all the details on the platform, and based on my risk, my credit assessment, it gives me some rating and the interest rate you know for required for giving loan to me. So and generally these rates are quite high. It could be 15, 20, 22% depending on how risky the borrower is. And when this loan is listed on the platform, the investors who have registered on these platforms, they can see those loans. So they see, okay, this is the guy, he wants 1 lakh and he wants a 20% interest rate. So if they're interested, they can show their interest, and they can commit some capital. Let's say I want to put 2,000 rupees. So there will be 50 other people like me, and they will each put in 2,000 rupees. And when the 1 lakh amount is completed, that amount is disbursed to that borrower, and then every month that borrower pays back that amount, goes to the escrow account and then comes to your account. So that's the model of P2P lending. So people need to be aware of the risk and reward in this platform. They need to assess what kind of borrowers they want to invest in. For instance, I prefer to invest in people who have a stable job, who have low existing loans, and who have their own house. It gives me a sense of comfort that tomorrow if they default, the platform can go approach them and collect the money, right? So, and there are a lot of platforms, so you can read about it on my blog, or you can do your own research. P2P lending in India. So this is another asset, and then so these are the conventional assets which are to the conventional alternate investment assets. There are many more conventional alternate assets, like fractional real estate I've told you. So then there is a lot of these days, a lot of people they've been talking about is cryptocurrency and blockchain. So a lot of people, either they love it or they hate it. So is there anyone in the platform who has invested in cryptocurrency? And okay, so what is a cryptocurrency, and so and what is different from a normal currency like rupees or dollar, and why do we even need a cryptocurrency in the first place? So there are ways to look at it. First, you need to understand what a currency is. So what does INR means? I mean, rupees is basically your government is saying, if you see if you read on the currency, it says I promise to pay the bearer this much amount of money. So basically, currency is just a promise by the government. The government is saying, today, something happen, if you go to a bank, I'll promise I'll pay you. But again, at the end of the day, it's a promise. If you see a lot of people, if they turn up to the bank, all of them at the same time, the bank will not be able to pay that money, right? That's what you call a run on the bank. So it's based on trust on your government, trust on the strength of the government to pay that amount of money. So you'll say, okay, and the government can always pay money, government can print new money, right? What's the problem? So that's the problem. So if you see a lot of economies which have failed in the past, Argentina, Zimbabwe, what happens is printing money or putting more money in the system comes at a cost. A lot of people do not are not able to comprehend it. But think about it. The wealth of the nation is not the amount of money each one has. It's about the productivity of the nation. So let's say a country produces some assets. You know, let's say they produce 100 apples. Example, I'm just taking a very hypothetical example. And initially they cost 100 rupees, 100 apples. And tomorrow the country says, okay, we'll print more money. If they print 200 rupees, does not mean that the value of the apple has changed. What has changed is now the apple will become 200 rupees, but the value is same, right? You can still buy the same, you can still buy the same apple, but now you have to pay twice that amount of money to buy the same apple. What happens is the value of the assets has appreciated, but your purchasing power has gone down. That's what we call inflation, right? That's what happens when more money is coming into the system, right? So if you have seen, if country keeps on printing money, what happens in Zimbabwe? You have to give lakhs, millions of dollars to buy simple food items because people do not even trust the money because they know because today if they paying some 100 rupees for something, tomorrow they will have to pay 500 rupees. So they don't want to transact in that currency because they're so uncertain about the future of that currency because they do not know because the goods are limited. The value of the goods is more important. That's why gold has become so important, right? Why? Because gold is limited. So it means if tomorrow government start putting more money in the system, so instead of holding money in cash, you won't want to hold gold because it is limited and will become more expensive compared to holding cash. Cash has become worthless because today, if say you're buying something for 100 rupees, tomorrow you'll have 300 rupees cash. So your 100 rupees cash has become 1/3 in value. But gold will become thrice in value, right? It's a hedge against the inflation. That's why gold is considered. That was gold has gone up recently because what you must have read, US due to the COVID, the government started giving money to a lot of people. They started giving money to companies. So it created so much liquidity in the system. The value of the money itself was eroded. So people wanted to move to a very safe haven. So they chose gold. Now coming to cryptocurrency. So think about, let's say, Bitcoin and compare it to gold. Bitcoin is limited, right? You cannot you cannot create more Bitcoin than it is already created in system. One, right? Second, it is liquid. It is more liquid than gold because you can transact easily. Third, you do not need permission from government. You need not permission from banks to do all those transactions, right? That's why if tomorrow, if I have to hold Bitcoin or if I have to hold cash, and if the government is printing a lot of money, I would hold Bitcoin because I know it's limited. Its value will increase, but the cash will depreciate. So that's why you must have seen if somebody is tracking Bitcoin, it has already gone up 200% last 5-6 months, right? Because suddenly people want to hold Bitcoin, right? So that is one of the reasons cryptocurrency or Bitcoin has become quite popular recently. And the thing is, why government or banks do not want Bitcoin is one, because if everybody transacting through Bitcoin, you will not need a bank, right? Because right now you need bank to make to have to hold your accounts. You need bank to know how much you are invested in. How much you owe someone, how much you for each transaction. If tomorrow someone can do it cheaply through a mode which does not require a bank to validate it, banks will become jobless. So that's why banks always say, you don't need Bitcoin. Bitcoin is bad, right? Why do government say Bitcoin is bad? Because then government will have no control over printing money. They'll be like, if they do not, if we cannot control the transaction, it will be very difficult to maneuver or control the economy. So that's why a lot of government and banks, they look at it in a very negative way. So how does Bitcoin fit into your portfolio? So consider Bitcoin as something which uh, has a huge potential. Let's say huge potential means it can go up to 10x, 20x, 30x, 40x, right? But it has a lot of risk also. What are the risks? Tomorrow government goes, crazy. They say no, we know Bitcoin, and whatever, right? Whatever reasons. So there's a chance that your Bitcoin can go down by 30, 40, 50, 60% also. But if you plot this graph, you can see the downside is if you put in 100 rupees, the downside is maximum 100 rupees, right? Upside is 800, 900,000 rupees. So, right, even if you put 3% or 2% of Bitcoin in your portfolio, how much you can lose is 2%. How much you can make is 20, 25%, right? So it makes a lot of sense to invest a small amount in it and invest in a very staggered amount. For instance, if you want to invest 2%, you can put 0.5% now, right? If it collapses further, you can add a 0.5%, right? So that's how you invest in Bitcoin. And then there are other cryptocurrencies also, which are not Bitcoin, but they have their own usage. For instance, you must have heard about Ethereum, and then there are Litecoin, and there are like many currencies. Some of them are like really bad. I mean, they could be scams. Few of them are good, right? And one or three, four of them can become 100x in like 3 years, 4 years. It's very difficult to understand which one will become very big. So how I invest in these kind of assets is, so again, there are a couple of platforms where you can invest in 10 to 12 promising altcoins. They're fund managers like mutual fund guys who keep on researching about these asset classes, about these coins, and then they create a portfolio. You can directly invest in those portfolio. You can invest, small amount, 1,000 rupees, 5,000 rupees, 10,000 rupees. Do your own research also. But I personally believe in having 3 to 5% of your portfolio in cryptocurrency, including Bitcoin. And in fact, recently, if you're following the news, a lot of big companies, like PayPal, they started accepting Bitcoins. A lot of big companies, their treasuries have started investing in Bitcoins. So now, when a lot of big companies start investing in Bitcoins, it makes give a lot of validity to the whole system. So that is, I think this next 5 to 10 years can be quite promising for them. It's like, the internet in the 90s. Everybody thought, it will never be big, but now it becomes indispensable. Maybe in 15 years, it becomes indispensable, right? So it's better to, at least learn about it. Even if you don't want to invest, you should not ignore it, right? Just because you not use it or because somebody says and scam. Learn about it. So that's about cryptocurrency. And then there are a few other assets which I have covered in my platform. Some of the assets you might not want to invest in because they would be too complex to understand initially. So there's a question: how is blockchain related to cryptocurrency? So blockchain is a technology, and cryptocurrency is one of the application of that blockchain, right? So I'll give you an example. So in fact, one of the alternate investment assets is based on blockchain. So, uh, so what is blockchain? Blockchain means, it's a distributed ledger. So what is ledger? Let's say, I give 100 rupees to you. So you maintain in your own accounts, and Rohan has given me 100 rupees, right? And I can write it in my own account that I've given you 100 rupees. So what is the proof of this, right? Tomorrow, if you delete it from your Excel, or if you say, you have not given me 100 rupees, I cannot prove it. Till now, I mean, for instance, there used to be central authority which used to say that. For example, the banks. The bank says, okay, they have their own accounts. They know Rohan has given 100 rupees to Guru. That is a transaction through Axis Bank, and the bank has kept it in its own record. And bank says, okay, I'll take 1 rupees from you for this transaction because I'm maintaining their record, right? Or the bank will sell you some other service, buy insurance from me and all that, or they using your data, whatever, right? Now, what is blockchain? Blockchain does is, so there's, let's say there are this 100 people, 100 people in the network of a blockchain. Technically, there will be 100,000 of people. So whenever I say 100 rupees, all of the system will have that 100 rupees in that, they will validate the 100 rupees transaction has happened, and that will add it on a block, right? So now no one can, it becomes immutable. You cannot, say that the transaction has not happened, because everyone in the system knows that 100 rupees has been transferred. They don't know my name. They just know one address has given 100 rupees to this address, and it is there in the record. So if somebody has to change that, so all the people in the network, they will have to change in their own record, which will require so much computational power, right? Which is not practically possible. That's why, now what happens is everybody knows about a transaction. You do not need a bank to do it, right? The system does it on its own. That's the blockchain. Cryptocurrency is again the same thing. Based on this model, cryptocurrency is a way to do transaction for money. So cryptocurrency like Bitcoin is just showing change in the value from one ledger to other. So the blockchain technology can be used for other things also. Let's say logistics, let's say something has been transported from somewhere. Everybody in the system says, yes, this is transported, right? So that is one application. It can be for data also on the internet, whatever. There can be so many different use cases for blockchain, right? For records, if you say, okay, I have registered, somewhere, everybody in the system knows that you're registered. That is true, right? That's the blockchain technology. And cryptocurrency is one of the applications of that blockchain. So recently, I have written, an article on gold mining royalty on my blog. So it's a very good application of blockchain. So what it does is, so there are a lot of miners around the world, gold mining companies, small, they have small mining mines, and they mine gold because they do not have access to good equipment. They cannot get the best out of the mines. They need money to do it, right? There's one way, they take loans. The problem with loan is they have to pay the interest, and they might not have. They're not sure, how early they can take out the gold. If they're not able to take out gold in the right time, they will default on the interest obligation. They can, equity. They can take equity, but the problem with equity is then they have to give away all their stake of the company. They do not want to give away the stake because they think it's very profitable for them. So the company has come up. If you see my blog, the company called Gold Phoenix with a very interesting business model. What they've done is, using this blockchain technology, what they've done is, so they say, okay, you invest in this company right now, right? Let's say through the blockchain. So they will issue a certain point of cryptocurrency based on the blockchain. So as soon as that, with that money, those companies will buy equipments to do the mining. And as soon as you have invested, as soon as they have the money, they start mining. And as soon as you get the gold, and as soon as they produce the gold will go to a wallet, in London, let's say, which will hold that gold. And let's say you invested 100 rupees, so they will put in 120 rupees of gold in that wallet, right? And you will get 20% of the gold that mine produces in the lifetime. So let's say the mine produces 500 rupees of gold, so you'll get 500 amount of gold, in the lifetime. So what is the advantage for the company? So for them, gold is just a raw material, right? So it doesn't cost them extra, right? So they're just putting in gold and giving it to you, right? And they're getting upfront cash. For you, it's good because you're getting so much more gold, right? Than just buying the gold right now, right? So, and both of them are benefiting in this process. And this whole event is being recorded in a blockchain, so that everybody knows how much gold is in that wallet, how much gold is owed in to each coin, right? So that's how the model is. And in future, I think this model will be applicable to a lot of other industries also, not just gold mining, but I've seen it can be done on, royalty of music or movies or other different mines also, or oil. It can be done on oil also, the oil production and all that. So this is a concept which is quite revolutionary and being accepted in the industry. So this is about blockchain and cryptocurrency. So apart from that, there are other ventures where people can invest in litigation finance, where you finance particular case. If you win the case, you get a stake in the amount of money the result of the case provides. For instance, somebody want to file a lawsuit against a company which has done them some harm, so they do not have enough money. So what this platform does is they pool the money from other people, right, and then they provide services like lawyers and all to that individual. And if they win that case, the litigation, let's say they get back 100 rupees because of a case, winning that case, that some amount of the money, 60, 70 rupees, is distributed among all people who are invested in that case. So again, there are a lot of other smaller or asset classes also which are quite interesting. And so basically, yeah, so there is a risk in this. They lose a case, so that's why you invest in 10 to 12 cases. So basically, if you win a case, you make a lot of money in one case. You can make 70-80% in one case, but in the others you will lose, right? So if you win 7 cases out of 10 cases, right? So you make up around about 50%. If you win 6 cases, you end up making 40%, and so on. So every asset class has its own risk and reward. So you need to understand it before investing in that asset class. Even your traditional asset classes like a bond, has a risk, or FD has a risk. If the FD has a risk, the bank will not be able to pay back the money on time, right? So we do not understand the risk. Sometimes we think FD is very safe, right? But if you beyond a certain amount, if the bank defaults, that is the reason some banks, a bank which is very stable like HDFC or SBI will not give you more than 4 or 5% on the FD. But a bank which has some risk, which is finding difficult to raise money from normal methods, is giving a higher return, like IndusInd Bank or IDFC. And so a question is how much percentage you should invest in alternate investment. So again, yes, it depends on your understanding of the asset class. Second is uh, depends on size of your current portfolio. So if somebody has a very small portfolio, then you can just invest in normal debt and equity, and maybe a very small percentage in alternate investment. But if you already exhausted your debt and equity, then you can allocate a higher amount in alternate investment. And second thing is the timing. For instance, right now equity, the Indian stock market is around 12,200 something, 12,100 something, 150. So this level, I feel, it's not a very comfortable level. I would want to put in a lot of new money into it, right? Because we all know how the economy is doing, right? And there's a huge risk that the market can correct 10 to 15%. It can go up also. So, but if you compare the upside and the downside, it can go up 7-8%, but it can fall down by 15-20%. And maybe in next 2 years, it doesn't even move, right? It ends up in the same place. So at this point of time, I what I personally do is I increase my allocation on alternates, like invoice discounting, and if the market corrects after, let's say, 10%, and I feel now the market is at a better valuation, I take out some of the money from my alternate and invest in your equity market. And second factor is how much liquidity I want. You have to also assess what is the requirement of money right now and in the future. You don't want to put in money in equity if you need the money in, like, let's say 6 months or a year. Right? So you have to understand and structure your portfolio that way also. Right? How much you would want to invest in something which is for a long tenure. Equity is like 5 years minimum. If you want something shorter, if you need money after 6 months, invoice discounting is much better. You're getting 12% annualized return and you have a shorter liquidity. If you're looking at 5%, you can increase your allocation to equity. If you want something at 10 to 10 years, you can add a little more cryptocurrency, because 10 years is something which you need to have in mind to be reasonably sure about the returns. So that is another factor. So in totality, a combination of all your assets, you should maximize your liquidity, you should maximize your expected return, and lower your risk. And you also have to consider, these days we have at least 5 to 6% of inflation. So you should at least try to get 10% returns from your portfolio to at least beat inflation. So obviously one way is to invest, in other ways obviously to save more and to earn more. I mean, nothing beats that. So you have to obviously be prudent in the choices you make while yeah, using your money also. You know if you're investing, but on the other hand you are recklessly using your money, so it will never grow. So you have to create kind of an Excel sheet where you see what your assets are and what are your liabilities. Assets are all your investment, liabilities are your savings, the credit card bills, and how you can minimize it. And then you can see how project your income, how your income will grow each year, right? And then see wherein you can cut your expenses, wherein you can enhance your returns, save more tax. All those things, they add up. Each small bit add up. 100 to 10% save right now, it's much more than 10% if you save 10 years from now, because the 10 becomes 110 in your investment, and 110 grows every year, right? So all these factors add up in the long run. I think from my side, I think this covers mostly. Uh, so I personally, I do not manage other people's portfolio, because managing portfolio, it's quite a active management role, and I feel I cannot do justice to it while doing my own job. But I'm more than happy to uh, talk to people and explain them about how I invest, what my portfolio looks like, and if they want to understand a particular asset, they can either ping me, or they can check out my blog, or they can just drop me a message. I'll be more than happy to help them out in whatever ways I can. And I firmly believe people should manage their own money rather than blindly trusting any wealth manager, because otherwise you'll never learn, right? You'll make mistakes, but you'll learn, right? You'll learn to understand how each asset class is different from each other. A lot of the time wealth managers, they have their own incentives for managing a particular portfolio, or their interests are not aligned with the investors. So you should research each asset class properly. So that's what I do. I generally tell people about all the asset classes, the risk and reward, the returns they can get. I tell them about how I invest, and then people can make the most judicious decision for them, because each person has his own risk appetite. There's no universal portfolio. So what is the minimum amount you can start with alternative? Again, depends on the asset class. For instance, cryptocurrency, you can start with $1,000 also. I mean, you can try it for $1,000. For P2P lending, you can start at 2,000 rupees also, very small amount. For equipment leasing, you can start at 20,000. For invoice discounting, you can start at 50,000. So a lot of these investments, for gold mining, you can start at 1,000, 5,000 rupees also. So, and I insist people to always start with a smaller amount, so that they understand it, and once they understand it, then they can invest more amount. So rather than going all in initially and then realizing it's something which is not their cup of tea. So start with the minimum amount they can. Tracking investments, so I generally do it in Excel. I think it's one of the best tool. And thing is, so we are not trading, we are investing. So once you set a plan, it's quite easy to monitor it. Let's say you thought that you will put in, let's say, 1 lakh in invoices coming. You're locked in for 3 months. You can just put it in your Excel sheet. This is the yield you put in, whatever, and then let's say gold mining, how much you put in, crypto, how much you put in. You can monitor it on the platform whatever you want. But for keeping a record, you can just do it in Excel. being a trader is tough because every day, you buy and sell. So I do not recommend people just, become a trader because it takes so much of a bandwidth. So a lot of people say that we like to do, share trading and option trading. So I generally do not recommend buying, individual equities. Also, I do not recommend because uh, it's very difficult to assess the exact information about particular equity. Because let's think about it. Someone tells you that buy 100 rupees of X share. What you know about X is from the news you have seen, what you read in the fundamental analysis report, whatever annual reports. This is all public news. Everybody knows the news, and that's why the share is trading at a particular amount. You don't know anything extra about that company, right? And there are a lot of things which are going inside the company which are you're not privy to. So a lot of those cases like DHFL and then Reliance and all of these things, people are not aware, and you cannot then put a lot of amount of money in one particular equity because you put a lot of money in one equity like Yes Bank and it collapses. Then what do you do, right? So you will never get that kind of confidence. So investing in shares is, I think it's not worth it unless you are professional and you spend all your time reading about it, making strategies around it. But then you need to have a big portfolio to it. If you have a small portfolio and keep on spending all your time, you could have spent that time as well somewhere else where you could have made more money learning new things. So that's my advice. Any other questions? If you have, you can ask me. Any queries, feel free to ask. If you don't want to ask right now, you can just drop me a message and I'll be happy to answer it if I can. So,
Hey, hi. This is Ellen. I just wanted to check with you. Although you advise not to get into share market and things like that, but it's one of the interesting experience that people can have and the knowledge that people can have. Although they may not do options, but they can do with the equity, with the small amount, with the whatever they think that it is safe, so that they can start learning how the whole market trend happens, so that at the later stage, if they are interested, they can get into a professional way of doing it. So do you suggest to keep be open to the knowledge and understanding and learning and experimenting, or you suggest to play safe?
uh, learning is very important. Even if you invest in a mutual fund, you should understand how equities work, what kind of companies are there in the portfolio. But think about it. There are more than 100 mutual fund companies in the country. 100 mutual funds, portfolios in the country. Compare the performance with Nifty. You'll find out of 100, only 5, 10 were able to beat Nifty. And all of those people, the 100 people, fund managers, spend all the time reading about those companies, right? It give you a sense how difficult it is to beat the market. So even if you buy a normal Nifty fund, chances are you will be able to beat most of the mutual funds in the market. That just shows how difficult difficult to beat the market. Second thing is, it takes a lot of efforts to read about these in detail, to get all the information you can about these underlyings. Problem is, let's say you want to invest 5 lakhs in equity, and if you spend all your time reading about equities, and positions and all that, and after that, let's say even if you are able to beat the market by 1%, is it worth it? Market gave 10%, you get 1%. So 1% of 5 lakhs, for that effort, is it worth it? I don't think. If you're managing a big amount, if you're managing 5 crore, 10 crores, yeah, it makes sense that even if you get 1% extra. So that is the question where you have to see the opportunity cost, the cost of learning time you're spending learning these things and implementing these. One thing is learning about, knowing about these things. That is very good. I mean, knowing about how equities work, what are the good companies and all. But taking a bet on a particular stock needs more than learning. It needs doing a lot of research. And even after all that research, the source of your data itself is stale. You need to understand that. What you're reading is the annual reports of company which have been published 3 months back. You don't know what is actually cooking in the company. So you can never have that kind of confidence when you pick a huge amount of money in that company, unless you have some insider information, right? So that is the risk. But if you want to take it up as a career, that is a separate thing. Then it makes sense to do that kind of research. But honestly, I'll tell you, if you have 10 years of experience in the IT industry, and then you think you can become a fund manager with a big company, it's very tough, because you would have no experience. How will you convince the people that you want to become a mutual fund manager and all that? So, but yeah, obviously some people they're able to do it, but it's not very practical. Any other questions? So regulations for these platforms, each platform will have its own regulations, and some will have a stronger regulatory oversight than others. For instance, P2P lending is governed by RBI, right? And then let's say cryptocurrency. The cryptocurrency is not regulated. That is the way it is, because that way it's decentralized. Everyone is validating itself, so that is the regulation, right? And then fractional real estate. So I invest in Europe. That is regulated by the European authorities, right? So in India, some platforms are governed under SEBI. So depending on the platform, they are governed under certain bodies. There are certain platforms which I would say not 100% governed. So there you have to take do a more a high level of due diligence of the promoters, of the funding they have got, or the business model, to understand that is it viable to invest. And just because somebody is regulated does not mean that it is a safer platform. That is also another thing. So just because it is regulated, you should not blindly put in money there, because mutual funds are regulated. I mean, BOI, I'll give you an example. BOI AXA, it was regulated under RBI SEBI. And if you look at the portfolio of the credit risk fund, it's gone down by 75%. Debt fund gone down by 75%. Why? So they invested in structured credit. What is structured credit? Is they invested in companies, smaller companies, like mid-sized SMEs, which needed loans. So they invested at 15%. So, and what happened is, in the good times they were able to get good yields, but bad times those companies are not able to pay, and all of them went kaput. So, and why were they selling these? And Boya was very popular. Why? Because all the relationship managers, all the wealth managers, they were selling these mutual funds, because they were getting a high commission, right? So you need to be aware, even if it is regulated, that does not mean that it is good, and vice versa. So you have to do your due diligence on each platform and asset class. So any good platforms for cryptocurrency in India? So if you go to my platform, so there are two things. One is cryptocurrency platform in general. Globally, there are a lot of good platforms, but problem a lot of Indian faces, they have to start investing in INR, right? So for that, I use WazirX is one platform. Then there are DCX, and there are a lot of, there like ZPay, and there are many others. You can Google also. From there, you have to use INR from your bank to convert it into either cryptocurrency. You can convert it into Bitcoin, or you can also convert it into dollar-based currency. So there are some cryptocurrencies which are dollar-based. So their values are very stable. They are called stable coin. So they like, for example, Tether is a cryptocurrency which is backed by dollar. So it means its value will be 75 rupees. It will track the value of dollar. So it is a safe currency. It will value will not move with like Bitcoin. So what I do is, using INR, I buy that, right? And whenever I want to invest, I from that currency, you can always buy Bitcoin, you can buy Ethereum, and all that. So there's a platform called Economy. So it is like a mutual fund of Bitcoin, so of crypto. So I put in some amount of money there, and then I put some amount of money in Bitcoin. So when Bitcoin had crashed in March, I invested in Bitcoin. Now today it's trading, I think, around 15,000. I mean, from 8,000 to 15,000. Not 45, from 5,000 to 15,000. It can correct again. It can correct 20-30%. But if correct, I'll add a smaller amount of money on it, right? That's the way you invest it. You know, not, it's not like investing in equity every month you put in a lot of money. You put in a small amount. 1 rupees in Bitcoin is like 10 rupees putting in stocks, right? That is the risk and reward, right? So I think, are there any other questions, or otherwise we can, just I can conclude if people do not have any other questions.
Yeah, I think we can close the session. So thank you, Rohan. I think it was a different perspective, at least for me. There are a lot of new ideas that you have poured in.
I think it will take some time to digest these things, because it took me a lot of time to read about them and then invest it. So a good place would be read about them. You could start by my blog, because I've put in everything from different platforms. Then in each asset class, you can do your own research also separately, and then start small, and gradually you'll understand them more in a period of time. Then you can invest more. So, but it's always good to know, what all there, in the world to invest in.
Correct, yeah. Thank you again, Rohan. Thank you to all the participants as well for joining.
Joining me. All the best, and feel free to get in touch if you have any queries.
Yes, sure.
Bye. Bye. Bye.
Random Dimes. I will send also the link to the website.
Thank you. Sure.
Thank
Bye.
you.
Have a good day. Bye.
Thanks all. Good day. Bye.